Hi everybody, I'm Dale Pinkert. Welcome to FACE. I also want to welcome our viewers from investing.com. It's FACE Day on their website, live streaming us. Welcome to our community. I invite you to become a part of it, not just on Thursdays, but every day. So I want to start off with something that came from our other trading room that subscribers are part of, and Blake did the drawing. The linchpin of everything, of course, is the dollar, and we have a harmonic pattern completing up here. I've tweeted that if the pound is going to make another attempt at new highs in euro, in my opinion, it's got to get going here within the next 24 hours, no later than after the NFP. And keep in mind that with the NFP tomorrow, there's another wild card with the debt ceiling. I don't believe that's been resolved yet. And with the acrimonious atmosphere in the Congress, who knows whether or not they're going to get it done, or at least have a temporary push for a week or so or into the new year. I think it's more of a wild card than it has been in quite a while as to whether or not we get a government shutdown. So that could be a wild card for the dollar as well. I would say that if it doesn't get done, people along the dollar would consider covering those positions, as it would look like there would be some confidence crisis brewing that we could even manage a simple resolution of not being able to keep the government up and running. Maybe it'd be better if they shut it down for a decade, but we'll see what happens there. And traders that have been following me for a long time know that I'm not a big proponent of carrying positions into the NFP anyway. To me, that's a binary event. It's a red or black roulette bet. In fact, I've often told the story that someone came up to me and said, Dale, I bought the euro right before the NFP. We got a weak number and the euro soared over 100 pips. And I said, lucky trade, because that's basically what it is. It's luck. It's not trading. I prefer to react to the number and take home only winning positions and lightly partial, so keep that in mind. I guarantee that the markets will be here after the NFP and the debt ceiling debate tomorrow. Make sure your equity is. Everyone with me? Give me a Y if you're with me. So I can't help myself. I can't help coaching, and I just want to make sure that anyone listening to me, hearing my voice, can avoid the landmines that I've stepped on and I've seen hundreds of traders step on during the course of my 3-decade or so career. So keep that in mind. Also, taking a look at what we have here at ForexAnalytix, I know that everyone hearing my voice has subscribed to one service or another, and what I think is actually outstanding and unique about ForexAnalytix, besides the great analysis and the technology on the website and the push alerts, everything that comes here is basically you normally, when you subscribe to a service, it's usually one person or two people. You know, maybe there's a partnership type of situation. But check this out. And, you know, when I was at FX Street, I interviewed Blake, I interviewed Dick, although it took a little work to get her on. I interviewed Greg Horvat. He was an award winner at FX Street that year. I was doing LAR there for about 3. Stelios, I didn't know. Contigolas, I don't remember the interview I did with Steve Volge. But Steve said that we did it, so that must have been a real memorable one for me. Just kidding, Steve. And then you have me, you know, the host of our live trading room that you're watching right now. And we also have Amanda, and Amanda's the newest addition to our team, and she moderates this chat room. We have 83 people here. It goes all day long. So this is for subscribers. Guys, you're on the Jumbotron. And after FACE closes, well, you know, say in about an hour and a half, traders can go in here, and if you're a subscriber for 6 months, you're able to participate. But even if you just try us out and subscribe for a month, you're able to come in here and observe. And something else I teach, and it could be lived out in here, is surround yourself with traders better than you. Okay, so I think that's true for me with the team. There are guys that actually have higher hit rates than me. I'm old, yes. Thank you, Ziggy. I am pretty old. So here's a look at what happens in here. We have about 82 in here. I've seen up to 100 here. So let's get to the markets. So it's my contention with what we saw in the Dixie harmonic that if the dollar is going to start to fade again, it has to get going in here. All right, so the pound, none of this in Elliott wave language, which I'm an amateur, looks impulsive. It's just been a grinding. We've worked off our overbought condition more in time than price, right? So now we have a very reasonable neutral level, not oversold, but neutral. And if we're going to get another shot up above 135.50, which I think is a possibility because of the pretty strong momentum reading you had here at the high, 75. Markets normally don't top when momentum is confirming the high. So this may have been the low here. We're testing this, breakout area that we pivoted against a few times. Same scenario in the euro. I drew this line several days ago and thought 1780, 1760 was going to be an important zone. So it's not the time to get real aggressive in front of what we face tomorrow, but maybe worth a probe. Perhaps some people that have been short euro for the last several days, maybe some short covering comes in here. But don't bet the farm in front of a big red number and the government shutdown. If the scenario is going to change, I would say would be back under 117, which has been an important pivot. If you get long term and you look at the euro, we've had a couple of significant turns here. This was a false breakdown on the head and shoulders. And as you can see, we talked about it down here being jaded and skeptical about it because it took too long to work, and then they negated that breakout. And here we are consolidating again. I guess the bears could say possibly this is 1 and this is 2 or B, and we're in a C that could take us down here. I'm in the camp that I still think there's another shot to the upside to challenge these 120 highs, or at least take out this high. And then I also want to update it and give credit to the FACE community, because it's great when someone uses my teachings and then bring, and it's not mine, I learned it from, oh God, it was a long time ago, the 3 drive pattern. Even forgot the name, Ziggy, you're right, I'm old. But it was on Canada, which I'm looking for. Here we go. J.R. Hill is the guy. So we were talking about the potential of a 3 drive yesterday in Canada, which was here. I wasn't sure if this was going to be counted 1 or this was going to be counted 1, but it ended up manifesting as 1, 2, 3. And we were trading in here yesterday during our webinar. And I said the way to trade it, if you believe it's a 3, is you could buy it here and have stops under 3, not 1 pip under 3. I advise, when people are looking at the market, not to put their stop directly under a swing high or swing low, because the algos go for those stops. That's why I have that handle, Forex Stop Hunter. I learned on the floor of the CME that there are such things as stop hunts. I don't know anyone in this room or anyone hearing my voice that hasn't been a victim of one. So you have to go ahead and give it more tolerance. Normally, if it's a stop hunt, it's not going to take out a swing high, swing low by more than, say, 25 pips or so. And how you know it is one is very shortly after those levels are elected, the people that are taken out will they'll see it back above their stop. So that's your first hint on that. So if anyone took this trade, it was a big one, was good for 200 pips. I don't know who it was that called my attention to it. Another great advantage of social trading is that we all only have two eyes, and we have quite a few attendees here in our webinars, space webinars every day, and great ideas flow from them. And then after the webinar, excellent ideas flow in the other chat room. I have an excellent guest live from the UK. Tim Price is going to be with us at the top of the hour. It's a money manager. His company is called Price Value Partners. So his name's in the name of the company, so he's most likely the big kahuna. Looking forward to interviewing Tim, and with the state of the market that we have going on right here, we have this big sell-off after the passage of the tax package, and everything's come off a bit. NASDAQ, the weak sister in my mind is Russell, but everything has come off here. And you know, everyone's kind of complacent. No one thinks anything big can happen in December because it's a year end, and you know, the Santa Claus rally. You better not shout, you better not cry, you better not pout, I'm telling you why. Well, who knows if that's going to happen. So, you know, I would prefer one more push up in the S&Ps up towards 2680, 2700, but we are starting to get some momentum divergences, so maybe I'm looking for one more jiggle that may not happen. So any questions before I turn it over to my teammates? Everyone's straight with what I said. You don't have to agree with me. I just want to make sure that you see it, understand it. But I think that if the dollar is going to make another attempt to go south, euro north, cable north, that it's got to begin fairly imminently, probably after NFP. I don't recommend loading the boat in front of the event tomorrow. And we will be here live tomorrow. Ashraf Ladi, I love Ashraf. I have in the past. I've extended a few invitations to him, and I don't know, you know, he has a very strong relationship with FX Street. Why don't you do it for me, Rio? Reach out to Ashraf and say, your buddy Dale would like to interview you. So, you know, that goes for everyone hearing my voice. I'm open to anyone that you guys want to interview. I want to hear interviewed here in FACE, that on my behalf, you're all ambassadors of FACE, that you could reach out to these people and get the contact information to me, and I'll extend the invitation. So you're part of this. You're not just someone watching, like going to a sporting event and you're just watching the players. You're part of the team. So
hey Dale,
go ahead
just
and
to mention,
do that. Huh?
Dale. Hey,
yeah,
good morning. Just to mention, you actually have a 2-month waiting list for people that are trying to get on our webinar. By the way.
Yeah.
I mean, you should also say that, just because, you know, if you do have somebody that steps in and says, hey, you know, I got so and so, they'd love to be on your webinar. It's a little bit of a wait at this point, but we can still get you in. It's just going to take some time.
And you know, sometimes, Blake, I'll keep Fridays open, and at times, you know, and at times there's a cancellation. But you're right. You know, I remember when I invited Todd Bubba Horowitz, and I gave him a date 2 months ahead of time. He said, Dale, I don't know if I'm going to be alive or dead by then. So, but you know, most people don't mind. They kind of look forward to it. And yeah, I think it's a great sign that people are willing to, you know, be patient and wait for their turn to come on. And I really do this just to really stay ahead of the curve instead of scrambling to get your schedule together to stay ahead of the curve. But we've had 0 guests that wouldn't agree to come back and that didn't enjoy being here. And that's because, you know, we get great questions from the crowd here and they have a good time. So, you know, it's a combination of enjoying it and at the same time providing compelling content to edify the community. But
It sure does.
yeah, thanks for mentioning that, buddy.
All right, I'll see you guys in a little bit.
Okay, so I'm going to pass it over to the most disciplined trader I know on the planet Earth, and that's Steve Volge. I've begun to call him Mr. Confirmation. And Steve, good morning or good afternoon to you live in Greece. How are you?
That's an exaggeration for sure. I'm good, Dale. How have you been, mate?
Good, buddy. So looking forward to I'd like to acknowledge, I thought maybe Aussie might have another leg higher. It failed right from that resistance and they took it right back down. Great call on that.
Thank you. It wasn't my call, it was the market's call. I mean, sometimes, you know, the market is very clean and, you know, that area of support resistance was, you know, very, very well defined. And, you know,
now we're approaching a number that you've had.
Yes.
On, you know,
that was my
radar
initial
screen
target.
for quite some
that was
time.
My initial target, the 75 area.
Yeah.
Exactly. So yeah, we are approaching there the confluence of it's a confluence of three different support zones. As you can see here, it's this ascending trend line. It's the 78.6 of this move higher. It's also a horizontal support resistance level. So quite an important juncture here at 75 cents. Obviously, if I was still involved with Aussie, I would definitely book some here. I can tell you that much. I think you know that whoever was following the downtrend should already have made some good bucks, and I think it's a good opportunity to cash some out somewhere here. You know, and keep you know another part of the position for another move lower. I'm guessing that if we actually break below there, then I don't see any major support area all the way down to 73.30. So, you know, if we actually penetrate through here, I think there's another 170 pips coming to the downside. But let's first see what the reaction is going to be of that. And the Kiwi is about to do the same. It's about to follow. The Kiwi was also in a well-defined triangle. The triangle's resistance was also extremely powerful because it was also the extension of the descending channel that we had there. And as you see, Kiwi has also failed in every attempt it has made to break higher, and we're currently testing the support area. Any daily close below the 68 and some change, 68.10 and 68.15, I think should bring Kiwi at least towards the 66 and some change cents, so another 200 pips lower, that is from there. So, you know, Kiwi looks like it wants to follow as well. Aussie has already done, has already made the first move in the same kind of way that silver made the first move and gold followed. By the way, I wrote it to the chat before.
Yeah.
I closed the rest of my position in silver because we have a confluence of supports here. I made almost 2.5% in the first half of my position and almost 5.5% to the second half of my position. So this has already made my month, and I'm holding though on my gold short. I have two entries here. One of them is at 12.89 and the other one is at 12.65. When I added.
Congratulations, buddy. Do you need my bank wire information now or later?
Yeah, please do.
Okay.
I intend to keep it because I think that perhaps now it's gold's turn to underperform silver, because silver has been underperforming almost for the whole year. If I remember right, year to date, gold is positive like 7-8%. And silver is negative 7-8%. So we have, you know, all year long quite a significant underperformance from silver. And you know, since gold is just breaking below the triangle, I think that, you know, temporarily we might see gold trying to do some catching up. So I'm happy to be holding, you know, my positions here. Obviously, I'm not going to jeopardize all my gains here. So I already have moved my stop loss in profit. I've already moved it actually at 1270 for both positions. And I'll ride it, and the best it can give. I'm going to be happy about it. The next support area I see here is the 1237, which is the 78.6 of this move higher. I'm probably going to book some there. I'm probably going to book half of my position there and hold another half. Now, what else do we have to show? Okay, you already talked about the cable. The cable was lower earlier, but we saw a reaction from there. As we said the day before yesterday and yesterday, I remain somewhat constructive on cable, but I don't want to see it trade below 133. So, I will be gladly making an attempt to buy it as long as I see it stabilize somewhere here and putting an effort to actually rebound. So, as I said, I remain somewhat constructive. I want to see a reaction first, and then I might even get involved. What else do we have? Yeah, I know a lot of people are looking at the loonie since we had that reversal the other day. So let me have a look at it. The loonie is clearly in a range at the moment, and obviously a break above should take us to the 61.8, which is going to be a level I will be very, very much interested to sell it. Also, a break below here should take us back towards the 124 zone. So quite a well-defined range. In my opinion, quite a good chance of a break higher for one last thrust from anywhere between 130 and 131.30, where, as I said, I'm interested to find a shorting opportunity, at least if the market seems to be behaving properly. I also reestablished some USD NOK shorts today. I'm barely in the money at the moment. My entry is at 829, and I have another entry level for another half of a position at 839. So I'm even willing to see it move higher from here. I just wanted to reestablish a position here because I really believe that either from here or from a little bit higher, it's going to be moving lower once again. So I'm involved with this as well. And the other position I currently have, which we haven't revisited in some time, is I'm short some DAX. I'm a little bit out of the money at the moment, but I'm viewing this as a triangle as well. So I'm willing to hold some in order to see it perhaps follow through for one more leg lower. So that's what I currently have on the table. But I have to say that gold and silver have already made my month. And being holidays and all that's coming, I'm not going to push my luck. You know what I mean? I have no reason to do so. Let's have a. How much do you think silver can rebound? Pedro is asking. Okay. Let's have a look at it more specifically. Pedro, I'll tell you what. I think that if we do see a rebound from here, because obviously nothing is guaranteed, a good level for it to go back to is the broken 61.8, because it's also that low that we had over there. And you can even see it like a stronger pullback, like all the way up to 1670. But definitely, as long as we remain below 1670, I would have no reason to be looking higher. Okay, so I'm not involved with it anymore. As I said, I just booked the last part of my short here. I'm quite happy with it. And even if you see it as a simple ABC move, I mean, I haven't done the measurement, but it should be somewhere there. I have done the measurement. Actually, it's down at 1550. So it can extend all the way to 1550 and rebound from there. But to be honest, I don't think that the reward to risk ratio is for anybody to be establishing fresh short positions from here. It makes no sense in my mind. You either traded the break from the triangle, the break lower from the triangle, or probably I would stay flat at the moment. I wouldn't go counter trend yet because we have no indication that it's reversing. We are at a level that would be interesting to see a reversal, but we haven't seen that reversal yet. I mean, I would like to at least see some big candle forming from here, or some kind of bottoming formation, but so far we haven't seen anything. So we might even extend down to 1550. But I don't want to be greedy. I mean, I already made a very good profit out of it, and I'm quite happy with it. I'm not going to be complaining, even if it moves lower. Another interesting question we have about the Aussie Kiwi. Actually, I was looking at it yesterday again. The Aussie Kiwi, listen, it's not a very clean chart because we did have a very nice move higher. Then we had a retest of this broken channel, and that marked some kind of a top. But since that point, we have been drifting lower. I can't really say that the move lower is impulsive in any way. But on the other hand, I can't also say that, you know, we seem to be about to turn higher. There is still no momentum. I mean, we are holding roughly near the 61.8 of the last move higher. But, you know, honestly, I think that there is no clean trade here. I mean, I would stay away from it until I see something that tells me that, you know, either the bullish momentum is about to, you know, to come back with force, or that actually this move lower that started slower is going to accelerate, and then perhaps we can view this as a totally different structure. But until then, I would maintain a very cautious bullish bias. Okay, so I don't think we have any reason to be bearish, but we don't have a reason to be buying at the moment. So my advice is just keep monitoring until there's something more solid here, which we don't have at the moment. Pound Aussie and Pound Kiwi. Let's have a look at them. People are asking for them. Okay, Pound Aussie, a textbook bull market for the moment. I mean, the first support area we were looking after this big reversal was this high here, and on a daily closing basis we never closed below it, and we're rebounding once again. And as I had said two things when we were looking at the crosses: the Euro Aussie, the Euro Kiwi, the Pound Aussie, the Pound Kiwi. And I had said the following: is that if I wanted to counter trend trade some of them, it would be the Euro crosses. And second thing I said is that don't forget that even if we move lower, for the time being, the uptrends are absolutely intact, right? We still have a series of higher lows, and that's the definition of an uptrend. So you need to be very, very careful. If you want to trade them counter trend, you need to be very, very careful. I mean, you know, manage your stop losses accordingly, your position, not use leverage, etc. Let's have a look at the Pound Kiwi as well. Pound Kiwi did the same thing. It held the first horizontal support area. It was resistance. Now it acted as a support. And, you know, as long as these levels are holding, you know, I have no argument for anybody to be short. Okay, so we have clearly defined levels. For the time being, they're holding, which means that we have no reason to not be bullish. USD yen. Actually, you know something, I'm not going to cover USD yen because I know that Blake is going to join us like within 5 minutes, and I know that he's going to cover it. So Blake is going to cover that for you. Okay. Obviously I have a I have an opinion about it, but I'll let Blake cover it. I'm pretty sure that we're seeing the market the same way. I can cover though a couple of other euro crosses, yen crosses if you want. One of them is the euro yen. I would just want to make sure to explain. I see a lot of people trying to get involved with the euro yen. I honestly don't understand why, since it's a market that has done absolutely nothing since the middle of September. I mean, we've spent like 2.5 months already oscillating in a clearly defined range. So, you know, in this case, you can do one of two things. One, nothing, and wait for it to break out and then trade the breakout. Two, go long the tests of support or short the tests of resistance. There's no third alternative here. So, for example, establishing a position exactly in the middle of the range that we currently are, in my opinion, makes no sense. Okay, and the only reason I'm covering it is because I see that a lot of people are trying to trade it, and you know, as I said, you have two options, A or B. Any other third option is probably going to chop up your account. Steve, may I ask in what time frame you post your ideas? Because 193.30 to 196 is a huge range to trade. So there is a plenty trade setups unless you're speaking about long-term time frames. Thanks. Questions about GBP Kiwi you mentioned. Okay, let's have a look at it. First of all, I don't think I gave specific levels for the pound Kiwi today, but regardless, first, you know, I mean, Martin, I know that you've been monitoring the webinars. You know, first of all, that I'm not a short-term trader. So, you know, I'm not a scalper. I don't use leverage, so I can ride positions, you know, for several hundred pips, or even afford to get stopped out for several hundred pips. Okay. Now, having to do with you know, somebody that went short, for example, at that big dark cloud cover we had there, obviously they could have made some more pips on the downside, but the 94 area has held, which means that in any time frame you look at the pound Kiwi at the moment, except very short-term time frames, you know, you can't really say that this uptrend is broken, right? So as long as we remain above this roughly 194 area, although I can see the potential that we're going to have another leg lower and like come lower than here, I'm saying that for anybody that wants to establish, for example, a medium-term position, being short still makes no sense because there is no confirmation that the uptrend is breaking, even, you know, for a little period of time, like a couple of weeks or whatever. Now, if I go down on a 1 hour chart, I'm sure that, you know, the recent price action looks, you know, quite bearish. I have no doubt about that, but these are not time frames that I'm trading. Euro pound, sure. Let's have a look at the euro pound. Okay. First of all, my expectation about the euro pound has been that it's going to break lower. Okay, because I'm seeing this as an impulsive move lower, this as a triangle, so a short-term pause of the move lower. It's not so much short-term anymore, but anyhow, and I'm expecting that, you know, the likelihood is that we're going to have one more leg lower, even if that's to be in total just a corrective move and not a new impulsive move, you know, for new lows. But still, I'm expecting one more move lower. But on the other hand, we're still holding this triangle support, right? So although I'm expecting another move lower to unfold, I don't have confirmation yet. Obviously, the several higher wicks that we see here also show that sellers are in control here. Every attempt we've made for a rebound the past few days has found sellers. So, you know, I maintain a decently high confidence that this thing is going to break to the downside, but, you know, there is no event yet. Now, if we see a daily close below, let's say 87.50, then I'm going to be quite confident that we will at least go all the way to 85, if not lower, towards 83.30. Okay, so that's what I see.
Confirmation strikes again.
Yeah, you see, I was waiting for confirmation in silver, and it worked out.
Yeah, that's why I call you Mr. Confirmation. In fact, okay. I think it's about time that we get you confirmed. All right, buddy.
Okay, we have a question about the Euro USD. No need to thank me, guys. I mean, my pleasure to answer your questions. You know, the Euro USD has been dripping lower, but do I see this move as a beginning of some kind of impulsive move lower? Absolutely not. I mean, even if we go down to a 4-hour chart, you can even view this. You can even see this as a descending wedge. I mean, I don't want to bring now the 4-hour charts from the other screen. No real point, because you can even view it from here. But this can even be, you see, like a pennant. So really, in my opinion, the thesis that the Euro USD remains constructive has not been affected at all. We have spent several days moving lower, and we've moved very few pips in essence, right? We've moved like 150 pips within a couple of weeks. This is not an impulsive price action. I mean, you never know, it might accelerate lower, but in my experience, there's nothing that has changed. I mean, the Euro USD, I view it as bullish, and I'll need to get persuaded for the opposite, and I'll need to see like very strong downside pressure. Until then, I would be happy to be buying it at any real move higher we see once again. So, for example, if I see a strong day tomorrow, just an example, engulfing 2-3 of the previous days, that's going to be more or less a confirmation for me that another leg higher is beginning towards at least the 121 recent high. I might even be buying it, actually. I mean, in my opinion, I will be trading with the trend in this occasion. So why not? And this also, I have to say something, this also is one of the reasons why I'm holding my DAX short, because we all know that there is a decently strong inverted correlation, and you know the recent triangle in the DAX, any kind of strength we see coming through the Euro USD is likely going to be the catalyst for the DAX to break lower for one more leg to the downside. So, you know, this is my thesis, and that's how I trade the two of them at the moment. Hey, Arif. Hi, mate.
Hey, Steve.
Hey, mate.
Good morning.
Good morning.
You got the sniffles.
You don't want to know about it. I slept tonight with
With baby in your face?
With toilet paper next to me, because I have a runny nose and runny eyes, and you know, probably a little bit of a temperature as well. I'm under the weather anyhow.
Oh, it sounds like it. You have to get actual tissue paper, or your nose is going to be rubbed raw. I think we keep like about 30 boxes of tissue paper around the house, even though we're very rarely sick around here. It's the worst thing is having the rubbed nose, the nose that's rubbed raw. Well, with that being said, I'll take over, since you're not. It sounds like you're not feeling too well there.
Yeah, I'm not in my best, but I'm managing.
All right.
By the way, Blake, I already bypassed a question about the USD yen. I said I'm pretty sure you're going to cover it, so I'm just telling you.
Yeah. Okay. Well, you know, it happens to be on my screen right now, and thanks for doing that. Here's the U.S. dollar Japanese yen, and I'll talk a little bit about it. You know, the U.S. dollar Japanese yen has been currency pair I've been, targeting to the short side quite a bit for the last few weeks, and you know, last week when we hit up here against the 618 retracement. That was it. It was like, okay, it's time to reestablish the trade after being short through the 114, 113.80s, covering it all when we were down here in the 111 area, and then you know, reestablishing it earlier this week. And actually, it's interesting that we're talking about it this morning. I actually put on a little bit more right here, but 2 hours ago. So not you know, right at 72, but like, you know, like right here. So we're right here. All right. And the reason why is because, as long as, my opinion is, as long as we stay below 113.20, I don't mind being on the short side of this. I still, you know, you can't look at the dollar yen, and let me remove these lines. These are from a couple of days ago. I'm going to go ahead and remove them. You can't look at the dollar yen without looking at, you know, bond yields and or bonds in general. Actually, let's go ahead and take a look at the bond market right here. If you look at bonds, the thing about the bond market is this is our 10-year U.S. Treasuries, right? The bond market, and I should probably take these out, because it looked like we were setting up an inverted head and shoulder pattern, or maybe even a triangle, right? And you can see that triangle here. What had happened is we broke down, probably got a lot of traders short last week as we started to break through this triangle. But the problem that you guys might see here, is we have a a false breakdown, and that has led to a reversal. And so bonds are now firming, which means that yields are coming down. The risk at this point, in my opinion, the risk is if we break through these highs. If we break through these highs in the bond market, that is going to trigger a swath of probably short covering in the bond market, which means that yields are going to fall probably fairly aggressively. And if that happens, then you have a serious move down in the dollar yen. And that's when, you know, the dollar yen starts, you know, targeting 110, maybe even, you know, when I say serious down move, I'm talking, you know, we start targeting 110, maybe even as low as 108, or the range lows down here. So again, the reason why I'm watching and trading this to the short side, but also watching very closely is the bond market, is because I think the bond market could catch a lot of traders off guard. One of the most aggressive positions in the market right now are short bonds. Everybody's short the bond market. Everybody thinks that the bond market is going to hell in a handbasket, you know, but we've got bonds that are actually holding up relatively well. And if we see a little bit of risk aversion, then it's going to spur probably some buying here. Now, when, you know, I said, oh, how about if we see a little risk aversion? Look, the market hasn't seen risk aversion in, God, I don't even know how long. Okay. Dale, are you still here?
Dale? Yeah, buddy. I am here, buddy.
So tell me about, really quick, I want to ask you a question. Tell me about the power of a throw over.
Okay. Throwovers are usually the terminal part of a move. The way to trade it is wait for the throw over to get back into the channel. So usually it's a terminal thrust. That's what I've noticed. It shakes out. Well, you know what? Throw over, say you're trading that return line, which is the upper channel that you have. Throwovers make bears throw up, capitulate, and then back on into the channel is your trade. It's like a failed breakout.
Okay, so exactly. So and I'm just gonna draw that right there. So what we have here is we have the S&P channel, and let me get rid of these fibs really fast. We don't need those for a moment. Okay. We have this channel, and it was in development. It's quite nice. It was very tradable too. You know, every time we get up here, we'd be like, okay, you know, here we go, knocking our head up against channel resistance, and we'd know that, you know, the current rally might subside a little bit, and it would, and you know, we come off and had this descending wedge, came off a little bit, broke higher, and we're like, oh man, this is a serious breakout. Now, when you talk about capitulation of sellers, you know, this is where you got that short covering rally, and then we got a reversal at the end of last week. This was Monday, excuse me. So Monday we gapped up because tax plan was passed over the weekend. We had you know, some misconstrued comments about the Flynn plea, you know, so the market gapped up, we reversed, and we've been under a little bit of pressure all week, but bulls really aren't too terribly worried about what's happening right now. But in my opinion, when you talk about a throwover, and that was a great explanation, by the way, Dale, is if you get back into the channel, you've got all the people that were short that covered. They're like, oh crap, I got squeezed again. And then you got all the buyers that got stuck up here, getting long. You know, they all got long, and so they're gonna capitulate, is probably not the best word, but they'll get stopped out. Then that just accelerates the downside. Then if you throw on data, news, whatever that perpetuates the move lower, then we could actually get a key reversal. Now, I wouldn't get too terribly excited while we're above 2,600. See this blue line right here? But if we break, if you read ForexAnalytix and you read yesterday's analysis, let's go find the S&P really quick. December 6th, that was yesterday, right? The SPX tested the previous channel support and held today. A move below that low would cause a throw over and be a near-term bearish event for the index, but for now the bulls still have control. That was yesterday's analysis. So that means if we break through this low right here, which yesterday's low would have been Tuesday's low, which would be right there, then that signals a reversal. And if we break through that low, now you're talking about the potential for risk aversion. Now it takes me back to the previous conversation we were having about the yen and bonds. So why is this so important to us as currency traders? Because if the stock market starts to feel some heat, and I'll tell you, stock market's been trading relatively heavy the last couple of days. If we get some profit taking here at the end of the week, and we start breaking down, and let's talk about tomorrow. Tomorrow we got non-farm payroll. Let's say jobs report comes in a little worse than expected, and the market actually takes that as a cue to sell. Which, just because if we have a weak non-farm payroll, that doesn't mean anything. More times than not, a weak non-farm payroll triggers traders to buy stocks because they think, oh well, the Fed's just going to stay looser for longer, so then they just continue to buy stocks again. So I don't know if a weak number, or let alone a strong number, is going to move the market lower. But let's say the market's reaction, I'm just using tomorrow as an example, let's say the market's reaction is a bearish one. Well, if it is a bearish one and the stock market actually starts to push lower, that means bonds are going to move higher. So we go back to the bond market analysis, then that means that bonds are probably going to be, touching 125 and a quarter, which would, be up here. Then you're at risk of really, squeezing higher in the bond market, and that means yields are going to go down. So that takes me back to the dollar yen, which we were talking about. If yields come down, that means the dollar yen's probably coming back down towards the, 111, 111.90, back towards 111, and maybe breaking down towards 110 and change. And that again, I'm coming full circle back into our conversation from 7-8 minutes ago about this is why I am still targeting the dollar yen to the short side. And let's be honest with the dollar yen. It has not gone up with stocks. And if you've read our free blog that we posted that was on Business Insider, you realize that the dollar yen and the S&P, they've broken correlation pretty aggressively over the last couple months. And you can see it from here. S&P continues higher. The dollar yen has not. And what is typically a very tight correlation between the two. We've broken higher in the S&P, and the dollar yen has not gone anywhere. So if we see the S&P go down, likely because of the long-term correlation with the dollar yen, if we come down in stocks, that means that the US dollar Japanese yen is probably going to come under some pressure as a result. So again, these are all factoring in the reasons why I don't mind being on the short side of the dollar yen, why I continue to add to the dollar yen, that conversation. I also want to bring up another chart, and I don't know if Steve talked about the euro dollar. I was running a little bit late, so I wasn't listening in earlier. Dale, did Steve discuss the euro a little bit? Probably did. Oh, you did? Okay. Hey, Steve, thanks. Okay, so here's.
I did too. Both cable and euro look like it's kind of now or never for if they're going to launch another attack at the highs. Should happen soon.
I would agree with on both counts, and let's just discuss the euro dollar really quick. If you guys aren't looking at the euro, we have a descending wedge right now, and if we break through, let's just call it 118.20, or 118.10, which is only 20 pips away from where we're currently at. Guys, it's only 20 pips away from where we're currently at. We've had a very tight trading range in the euro dollar. So if you think about the tightening trading range we've seen the last couple of days, and we've only had a 30 pip trading range, 32 pip trading range in the euro. If we pop to highs right now and we break through 118.10, we're probably going to 118.50. So if we have this descending wedge that looks like this, we break through these highs here, we're probably going at least back here. And this is ahead of the jobs report. So now remember, tomorrow's the jobs report. I don't know what's going to happen with the jobs report. It's like a lottery, you know. It's kind of like eeny, meeny, miny, mo. Who knows? But it could squeeze the euro dollar a little bit because there's a lot of people that have been trading the dollar long for the last few days. So you could see a little bit of long liquidation ahead of that report as well. So you got to keep an eye on the euro. We could have a nice little squeeze this morning if the dollar starts to pick up some downside momentum here, especially with stocks coming down. Stocks and the dollar have had a pretty strong correlation as of late. So if we see the stock market come down, the dollar will probably come under some pressure. You can see the dollar yen's already starting to roll over as the S&P is near its lows, the overnight lows. You talked about the cable. Yeah, the cable. If you use ForexAnalytix this morning, the pound hit, here's the 1 hour. The pound dollar has had a wild session with a spike higher, now down through the 618 retracement and close to the uptrend line. A break of the 113.15 level would not be bullish at this point. And we stopped right at the uptrend line and we happened to bounce from there. And actually we bounced quite aggressively. If you look at the hourly, and there's no news, by the way. A lot of people are speculating that the pound is moving, probably more on maybe some rumors. Remember, Theresa May is trying to piece together a deal with the DUP party. Is that correct? For those of you guys that live in Europe, regarding the Irish border. And a lot of people speculate if a deal doesn't get done this week or actually by next week, Theresa May could resign. And so she's going to be frantically, and I think most people in the UK would probably agree that Theresa May doesn't want that to happen. She doesn't. She wants to be her. I think that's a lady who really wants to have a legacy and will do anything in order to navigate through Brexit successfully. So she will be remembered in the history books as the one who did. And again, you guys in the UK more than welcome to chime in about all that. But this is just from the comments that I get from my team and from other people around in the UK. But regardless, I think it's in everybody's best interest to piece together some sort of deal. And if they come to some concessions and the deal does get done, I was reading some analysis from, I forget what bank it was yesterday. I read a lot of bank analysis throughout the course of the day. It was like from one of the big top tier banks. They're like, if a deal's pieced together, sometime this next week, we could see a 3 to 5% move higher in the pound, just on a sheer, surprise, like, oh my God, they got it done. We could be really trading above this resistance. And are we closer to a deal? I don't know, but we had a really strong reaction off the support. So technically, any which way you slice it, and this is support on many levels. And why is it support on many levels? Well, this was the breakout point. This is that support. You think about the multi-year, broken. Here, this is the multi-year broken triangle, and you have to use these longer-term things. The longer-term trend lines when you're looking at multi-year. Let's go to a weekly chart. When you're talking multi-year trend line, you can't say, oh, it hit it to the pip, so I'm getting long or getting short. No, the support and resistance, especially regarding trend lines, is a zone, and especially when you're talking about a weekly chart. You gotta say, okay, give or take 30, 50, 60, 70 pips, that we're around the right area. And as you can see in the pound dollar, I mean, we're just pushing around this really important trend line. And what would be really a big boost for the bulls here is if we close at the highs or close higher today. That means we've respected this multi-year trend line. So so the pound, like I said, it looks, you know, relatively constructive is long. And Steve said 133. Well, I think the line in the sand really now for the pound is the overnight low, which came in at 133.20. You know, as long as we can hold that, there's no reason to be bearish the pound. Now, I will change my tune if we break through 133.20, or you can say 133. We break through that, and yeah, I think that that we have to start looking at the pound as a potential false breakout type of thing. Joe says the pound probably moving even more on lack of liquidity ahead of payrolls, especially in December. Yeah, I mean, we have, you know, obviously probably a pretty volatile jobs report coming up. Now, what is, and Dale, I'm going to ask you this question. What do companies typically hire for these months of the year?
Well, I don't know, but I got a part-time job at Home Depot.
Okay, well, there you go. You got.
I'm going to be a greeter, you know. And, hey, welcome to Home Depot. So, yeah, holiday shop, you know, holiday season.
Yeah, holiday season, and you know what? That's what a lot of retailers do. Have you been to a retailer recently?
No,
like a brick and mortar.
No,
I was in
agoraphobic. I rarely leave my house.
I was actually, that's surprising to me. I was in the mall over the weekend because I had to buy a jacket. I need a jacket for travel, like a big heavy coat for Northeast travel, and because I live in Arizona and I wear flip-flops all year round pretty much.
Was it jam?
No, I was in the men's department, and aside from a couple people walking around the aisles, yeah. I was only, and I'm talking about, I was in Macy's, I think I was in Macy's, and this is vivid where I got it, and I picked up a jacket at Macy's.
I know where you were, in Scottsdale.
Yeah. But no, I was actually in Paradise Valley.
Okay, I know that one.
But I was sitting there, and I'm like, I'm the only person here right now.
Amazon. Amazon.
Well, the reason why I say that is because online retailing is, you know, Amazon accounts for, I read this, and don't quote me on it, but they're accounting for over 50% of the online sales this year. And how much of the sales are being bought online? I mean, I out of what I've spent this much for this so far for the holidays up until this point, and I actually went shopping last night to buy a few knick-knacky things. I've spent more than half of my money online. So if you think about, like, is the retail push for employment going to be bigger or less than last year? Right. And is it going to be a downside surprise? I think analysts obviously are going to. You got to watch this euro, guys. It's starting to firm up. You look at it coming right up into resistance.
Exactly what I said early in the session, buddy.
Yeah. So anyway, it's just, guys, it's some things to talk about. Now, everybody, everybody's asking about Bitcoin. This is the big elephant in the room. Dude, Bitcoin. It is parabolic, and I know Steve is bummed out that he's not bummed out that he's not in it, but I'll tell you what, I'm bummed out that I'm not in it. You knew I was going to say something. I mean, we are absolutely parabolic. I mean, we were talking about it a week and a half ago when it was trading around 10,000, and we thought that it might have peaked that day, and here we are, another 50% rally from that point. This market is completely parabolic, and I'll say it again, that the risks associated with buying Bitcoin at this moment are quite high. Do I think that Bitcoin's going to 50,000 in a year or 100,000 in 2 years? I think those are all possible. And if you bought Bitcoin right now and closed your eyes for a couple of years, would you be happy? You might. I think it's possible, you know, but if you bought it today and you closed your eyes and you open them 2 months from now, would you be happy? I don't know. I think the risks are that Bitcoin could, with these parabolic moves, could come down quite aggressively at any point. And so that risk associated with where we're at currently and the risk reward trying to buy it right now, I don't know if I'd be willing to, you know, invest my hard-earned dollars doing that. But it is parabolic, and trying to short it, I mean, that's a fool's game too. And trying to figure out where it's going, that's a fool's game too, because we don't know. And it is parabolic. And I was reading a risk of 2018 from FX Macro, and one of the risks are one of the many risks going into 2018 is Bitcoin collapses and crushes the confidence of the retail investing community, which right now you've got everybody flying high buying Bitcoin. I had one of the best traders I know was at his clubhouse in Boca Raton, Florida last night, and he said there's not one person in the bar right now that doesn't have a story about what's happening with Bitcoin. It's scary. That was his text to me last night. So just some fuel for thought, guys. And with that being said, Dale, do you have an interview today?
I do, with Tim Price, live from the UK.
Nice. Well, hey, you know what? I bet Tim probably has some comments about Theresa May, because my comments are from somebody in the desert in the United States, which really has no reason to be commenting on UK politics. So maybe Tim has some better ideas on what Theresa May is thinking and how things are going in the UK. So I'd be interested to hear about his ideas on the border deal.
Okay, buddy, I'll ask him.
All right, thanks. You guys have a great one, and Dale, have a great interview today.
Thank you, buddy. Good hunting, everyone. Thank you, Blake.
Thanks, Steve.
Steve Volge. Tim, I'm
Thank
now
you,
going
Blake.
to make you the presenter. So I'm passing you the baton and looking forward to hearing your voice. And I'm not sure if you want to share your screen. If not, that's okay. I also have your website up if that's the case.
Can you hear me, Dale?
I can, Tim. How are you?
Excellent. Very good, thanks. How are you?
Good. Great to meet you. Did you want to show anything or screen share?
No, I've got. I'm afraid I've got nothing to bring to the table. So my cupboard is bare, sadly.
Well, then what I'm going to do is I'm going to keep your. I'll get your website up here, and make myself the presenter so people could at least see what you do. And I'm showing my screen now. So why don't we begin with UK politics? If you heard Blake's question, what's your assessment of what's happening with Brexit right now? And then
yeah, I mean we have there's a satirical political satirical show we used to have here called The Thick of It, written by a guy called Armando Iannucci, and he's one of probably our better satirical comedians. And he coined this phrase, omnishambles, which is where absolutely everything that can go wrong does go wrong. So we had an omnishambles budget.
Murphy's
exactly,
okay.
Like Murphy's Law to Power 10. And I kind of feel a little bit sorry for Theresa May. I mean, I'm not really a political animal, but I have to say, I think I get the sense that she's out of her depth. I was very, very strongly in favor of leaving the EU, so I'm delighted that the referendum vote went the way it did. But unfortunately, we have a huge problem in the UK, perhaps similar to the political problem, if you can call it a problem in the States, namely that you have in your instance, you have a president who's very polarizing. So yes. I don't know if you'd concede that the US is pretty much split down the middle between people who are for Trump and people who are against him. And we have exactly the same problem here in relation to basically Leave versus Remain. So although Leave won the vote by, I don't know, 1 million or whatever it was, and that actually only equates to like a 52. Exactly, 52% versus 48%. So it's a very cut and very narrow thing. Anyway, the point about Theresa May is that she was a Remain supporter, and she's been asked. So we're asking a Remainer to do a Leaver's job, and that was always going to be problematic. And I won't name the politician who said this about it, but one of the best political speakers we had in the UK. He's actually an MEP, a member of the European Parliament, not a member of our own Parliament. But he said the problem with Theresa May is that she's got all the charisma of a broken speak your weight machine.
Wow. Okay.
And bear in mind, he's actually a member of the same party, the Conservative Party, and so this is the problem, that you have someone who's I nurse no ill will at all towards her as a person, but I think probably the entire country now just has this lingering suspicion that she's out of her depth. And more to the point,
so at the minimum,
like
we could say that Theresa May is no Margaret Thatcher.
Absolutely, yeah. I mean, exactly. Sort of cometh the hour, cometh the woman, and as you know, I think one of your politicians said, "Sir, you are no Margaret Thatcher."
Yeah, that was, I believe, it was Dan Quayle. I forgot who the other candidate was, and he said, "Sir, I worked and knew John Kennedy. You're no John Kennedy."
You are no John Kennedy, exactly.
All right, well, I appreciate your insight on that. So the Brits are just as confused about what's going to happen there and conflicted as from our view across the pond. Is that
it's a very, that would be a fair way of putting it. It's a very strange situation. I heard, and I think this touches everything about the culture. It touches media, it touches politics. It's become an all-pervasive topic. And we, in our household, we have a radio in every room, and that radio, each of those radios is tuned to BBC Radio 4, which is like this kind of the adult channel, the grown-ups, and it's sort of talk radio stuff. And BBC Radio 4 had some coverage yesterday, a program called the PM program, and they had an interview with a UK businessman who has an export business. He actually has a manufacturing business, and I'll see if I made a note of exactly what he said, because I was so struck by it. So this is a guy called John Elliott, and he has a company called eBack, and he said, and in relation to Brexit, he said, tariffs, exchange rates are a nuisance, not a deal breaker. Every time you make a change, there's a cost, but the long-term benefit should be worth the cost. We've just got to sort it out. We've got to move on. The secret to export is not tariffs or trade agreements, totally irrelevant. It's getting a product that customers want to buy, and then you've got to go and deal, and that involves price. And then he goes on to say 56%.
How about, did he mention currency?
No, well, he did say that currency.
Yeah,
no, he did say that currency is clearly one of those factors that you have to be aware of. But he said it's not the be all and end all. And he then went on to say, nearly 60% of UK trade isn't with the European Union. People are behaving as if the entire world was the EU. But, people have just lost all perspective on this. And he's saying, we sell to America. I don't know the difference between selling to the USA and selling to France. The key thing is simply getting a decent product that customers want to buy. And in his argument, in his perspective, there's all kinds of businesses, particularly big businessmen, they've got it out of all proportion.
Yeah. Okay. Interesting. All right. So now let's focus on you, Tim. So, I have your website up here, and I know that everyone goes from point A to point B. They have a journey. The journey, that's your first step, the beginning of it. So why don't you tell us a little bit about your history, how you got involved in managing money, and did you have mentors? I know I could see by your site you have gravitated towards the teachings of Benjamin Graham, but why don't you tell us what it was like, I don't know how many years ago, but your first entree into the industry?
Sure. So I came into the financial services industry completely by accident. So I read English at university, and then I originally intended to become a journalist, to work in media in some form. And I started work in 1991. And in 1991, we had a fairly bad recession here in the UK. And the only job I could get was perversely as a bond salesman for a Japanese bank. So slightly unusual outcome. But but I spent say roughly 10 years as in fixed income sales, and then made the move that really changed things for me, which was to move into private client portfolio management. And that's when the scales really fell from my eyes. So my experience of working for for sort of Wall Street firms, I was with Merrill Lynch until 2000, was that you get pushed into narrower and narrower silos, narrower and narrower sort of product specialties.
You're a distribution guy. You're not there. There's no thought or a strategy or tactics or anything.
Well, there's that as well. And there's also the aspect of sort of being a cog in a machine and all of that. But what particularly struck me was that people were being forced into increasingly narrow specialties. So, for example, if you were a trader, a bond trader, you might start out, say, in European government debt trading, but then you'd have to be because of the way the system worked, you have to start trading German government debt, and then after a while you have to start trading 2 to 3 year German government debt, and it was just so restrictive. But when I made the move with Merrill from trading to, or in my case sales, to portfolio management, all of a sudden private client portfolio management in particular, as I say, that the whole world suddenly opened up. So I'd argue that there's two specialisms, or two roles in the capital markets that give you complete carte blanche, a complete freedom to trade or invest in whatever you like. One of those areas is private client wealth management, and the other is, and I say this as a hypothetical because I've never worked for a hedge fund, but I suspect the only other one that gives you the same kind of latitude is working for a good sort of global macro fund. But absent that, unless you're a private trader, private investor, then the only way you can get, if you like, to sort of to get involved, to play around, and sort of really sort of cast the net widely in terms of markets is to work in a private client environment, because in every other respect you're forced to specialize in something. I think it's very restrictive.
Okay, so I'm assuming that you made that move to start your own firm from
exactly. So yeah, that happened. So I started out in portfolio management around the turn of the millennium, and then about 3-4 years ago, finally had enough capital and clients as well, to be fair, to set up a specific business. So that's Price Value Partners, and we effectively have two offerings. So as you correctly infer from the website, we're big fans of Benjamin Graham. So for anyone that isn't familiar with the name, I suspect most of your listeners would be, but the godfather of value investing. So we have a value investment fund, a global sort of Benjamin Graham style fund. But the other offering we only have two offerings. The only other offering we have is a kind of like a discretionary sort of multi-asset offering, which is entirely bespoke. And that's all we do. But in every sense, the kind of value ethos persists. So I'm not sure I can bring too much to the party when it comes to, let's say, short-term trading. But the kind of things that we look at as the day-to-day, value equities is clearly one of them, and that's around the world. And our favorite market at the moment, for example, is Japan. And that's on a valuation basis. But there's plenty of other factors, I think, that make the Japanese market and the yen look particularly interesting. And the other areas that we look at, up until recently, we would have invested in objectively high-quality debt. But now I'd argue that there isn't any left. And even if there were any, the yields are so derisory that the bond market is just far too risky to be deemed investable. So we don't really touch bonds anymore. The other two areas that interest us, one of them is the one type of hedge fund investment that we make, and that's what we would call it uncorrelated investing. But in the US, you guys would probably refer to it as CTAs, or we'd call them systematic trend following. So very much a momentum-based approach. And then the final link in the chain is, well, again, we'd call it real assets, but for real assets, read primarily the monetary metals, gold and silver, because we are convinced that because there is this crisis of debt, there is too much supply of debt in the system globally. Ultimately, the only way that problem can be reconciled is with what I think is going to be a messy inflation. Exactly.
Okay. All right. So we've been waiting for it to rear its ugly head, which has been pretty much buried in the sand for a while. What do you think is going to be the catalyst? Higher energy prices, continued central planning, where perhaps our own Fed backs off of its plans to tighten. What do you think is going to be the trigger for higher inflation going forward?
I honestly don't know, but if I were forced to sort of, you know, to single out one specific factor, I think it's perhaps it's most likely to be currency weakness, and that would clearly be a sort of rotating process, because clearly not all currencies can be weak against each other at the same time. But the rationale, so if I express it, say, in UK terms, to start the point, Her Majesty's government, the UK government, will never struggle to service her sterling-denominated debts, because Mark Carney at the Bank of England will always be able to print money. So for as long as we've got sterling liabilities, i.e. debts, we'll always have a printing press to be able to service that debt. We can't guarantee the purchasing power of the currency, but we can guarantee at least that the money's there in nominal terms, simply to make good on interest payments and principal repayments.
Don't you think with you know, the dollar still remaining the reserve currency, that for this scenario you're talking about, that the negative or debasement of a currency has to happen with the linchpin being the U.S. dollar rather than?
Well, possibly, but I'll just finish off on the UK, and we can turn over to the US.
Okay.
So from a UK perspective, currency printing is not an issue. It can always happen. Clearly, that's not a luxury that's granted to the central banks of the Eurozone economies, because they're not in control of their own monetary policy. So whereas we, at least in the UK, have that kind of, you know, pressure escape valve, in Europe they don't, or in the Eurozone they don't. So that's a big issue, and it may come to be a big issue that ultimately brings down the Euro project. Perhaps from the periphery in, where you get an economy like Italy, where the banking system is completely unreconstructed and probably arguably insolvent, because they can't depreciate their currency the way that they used to in the past. But if we go back to sterling, so the UK, the Bank of England is all over the bond market, what we call our gilt market, and so I'd say that, you know, however much our spending goes up, particularly if we get a disaster of a sort of Labour government under this guy Jeremy Corbyn, no matter how much debt needs to be issued, the Bank of England can practically infinitely buy this stuff under its quantitative easing program. If you accept the logic of that, then the only market that I think is big enough for traders to express a judgment call on, say, fiscal credibility, is currencies, because the one market that's bigger than every central bank is the currency market. So I expect, in as much as, you know, because I mean, trying not to sound overly like a conspiracy theorist, the reality is that there's an enormous amount of market, let's just call it market manipulation, going on through QE, through quantitative easing, and having a more or less zero interest rate policy. The one market that I'd suggest is too big, even for the world central banks concertedly to dominate, is the currency market, is foreign exchange. So if, for example, we get, say, I mean, the disaster scenario for the UK is that we get a Labour government, and we get a return to the 1970s and sort of economic crisis writ large. Then
that was a brain drain. I'm old enough to remember that, right?
Yeah, well, I mean, in 78, 79, what we call our winter of discontent, you had, you know, corpses went unburied, you know, the grave diggers went on strike, rubbish piled up in the streets. You know, we were forced in 76, we were forced to take to go cap in hand to the IMF for an emergency loan of, I think, $4 billion, which was a lot of money at the time. So those are the kind of things that are potentially ahead for the UK as in a sort of return to the 1970s. But the one market that the Bank of England can control is interest rates, is the gilt market, is market interest rate, and it can sit on the entire yield curve if it wants. But the one market it can't control, and we saw this in September 1992 when sterling was ethnically cleansed from the exchange rate mechanism in Europe, is the currency market. So what I'm wondering
why can't the Fed, if you contend that the BOE can control, you know, the whole curve, Why can't the Fed do something about the flattening of the yield curve here in the U.S.?
That's a very good question. But I mean, one thing that Janet Yellen has said, and whoever's going to replace her is likely to say is it's now become kind of like market accepted wisdom that the Fed's now in call it tightening mode. So we've already had a few rate hikes already, albeit baby steps and sort of 25 basis point tightening. But also it's accepted that the Fed for the foreseeable future is into we'll forget tapering. It's tapering. So it's actually a final reversal of all the stimulus we've had for the last 7 or 8 years. So
in the light of reversing the balance sheet.
Exactly. So on that basis, it would be inconsistent for them suddenly to start playing games with the yield curve. But you're absolutely right; they could certainly do that if they wanted to.
Okay, so it's more of about their will to not want to play with that.
Well, I mean, my colleague Killian, who works with me in the business, says that he does not underestimate the kind of dogmatism of central bankers right now. And I mean, I can't speak for the US, but I can tell you in the UK, even with interest rates at 5,000-year lows, there are millions of people who can barely afford for the interest rate cycle here to turn up at all. So in other words, you've got so many people on, who have mortgages
leverage
on, let's say, a variable rate, and they literally cannot afford for rates to go up even by a quarter of a point.
Like governments. Including governments.
Conceivably including governments, but again, governments are playing all these games to their central banks, so you're not seeing a fair market price in the bond market at all. But for those people, I mean, for those people who have mortgage-related debt, there is a huge cohort of people who are going to be made borderline insolvent or bankrupt if we get the tiniest rate hike here. So then you have an existential question: if it's too politically painful for rates to go up, can rates go up? And I'm not sure we know the answer to that question. But the US has already shown, the Fed's already shown that you can tighten this thing, because we're at that gentle upturn in rates has already started. And this is the thing that interests me from an asset allocation perspective. The one iron law in finance is if interest rates go up, bond prices go down. So with interest rates at 5,000-year lows, who on earth would want to be long bonds now, other than those entities that have got no choice because they're forced to own them by regulation?
Okay, so let's just shift. You mentioned Japan. So I have a monthly chart up of the Nikkei, and as bullish as the chart looks, we still haven't recaptured the highs of 1989. Is that kind of a thesis that you have, that most world bourses are making new all-time highs, and yet Japan still is, about 20% away from highs?
Oh, it's still 40% below the 89 high. I mean, Japan, I think, is one of the most incredible opportunities for investors at the moment. The reason why we have such faith, such conviction about this market is not based on some kind of macro view about trying to forecast the market direction. It is predicated quite straightforwardly, simply on bottom-up valuations. So I think something like a third of the entire Topics index trades below book value. Japan is the cheapest developed market in the world, and yet, and as you say, it's well away from the highs that we last saw in '89. At the same time as every other major market in the world has barreled higher over that period. So it makes Japan look even worse. The underperformance is so much more startling. But from our perspective, the rationale for Japan is as follows: it's the third largest economy in the world, and yet it's being given away. It's the cheapest market. It's cheaper on, for example, a forward price earnings basis than either the US or Europe. But one of the other reasons we like it is as far as we can tell, I was in Tokyo earlier this year, so I can speak to some of this anecdotally. There's a kind of consensus out there that Abenomics hasn't worked. We'd completely disagree with that from our perspective, particularly in like small and mid-cap Japan. There are lots and lots of Japanese companies that are away from everyone's radar, under the radar, that are quietly making record profits now. but they're not. You're not necessarily hearing about them because people. I think it's because it's a kind of.
Oh, that's going to be a wrap
thing.
for today, guys. Oh, you're there. Okay, Tim. So yeah, lost you for a minute.
No. Can you still hear me? Hi.
Yes, I could hear you.
Yeah. So as I say, you know, Japan just strikes us as being screamingly cheap, and yet you've got these other factors that are helping it out as well. Namely, you know, you've got Japanese companies restructuring, they're paying higher dividends, they're buying back their stock aggressively. It's like, what's not to like about this market?
The demographics.
That's true, but then okay, to your demographic.
That's the only thing I could come up with.
To your demographic argument, I'll say, okay, well, they're going to give you the world's most sophisticated robotics technology, then, aren't they?
That's a good one. So, do you have an outlook on U.S. dollar yen with your outlook on, you know, stocks trading below book on topics?
We've hedged about half of our yen exposure within the fund because we've got about 40% of our fund allocated to Japan because we like it that much.
Okay.
But we've hedged about half of that exposure. Having said that, it seems to, I mean, so we don't trade currencies, but it seems to us that there's a plausible thesis that the yen is now in a new bull market, and yet we think there's equally a plausible likelihood that the Nikkei and the topics are capable of rallying even with a market where the currency is strengthening, and that hasn't been the case for some time.
Oh, interesting. So, all right. So if there, you know, a lot of people trade U.S. dollar yen, the strength comes in during risk aversion here, and then people go into bonds and sell equities. And really, have you noticed the underperformance of U.S. dollar yen? It hasn't been going up, hasn't been going down, very much sideways, while the Nikkei, normally the yen would participate and weaken with the move in higher in the Nikkei. What do you think is behind it, not that correlation kind of breaking down?
I don't have a strong view. I mean, the only thing I would add to that is you're seeing all kinds of quite freakish market behaviors in a number of markets this year. I think I'm right in saying that the stock market has actually been less volatile than the bond market in 2017. And if that's true, that's kind of incredible.
It is. So we live in incredible times, and it was an incredible interview. I'm really glad I reached out to you on Twitter, Tim, and I'm showing Tim's website. So do people have to be from the UK to retain you, or can they be from anywhere?
We can't unfortunately accept subscriptions into the fund from US persons, but we're more than happy to work with Americans in our discretionary business. So we're happy to engage with US people.
Okay. And minimum accounts?
Effectively, for the discretionary service, $500,000.
Okay. All right, Tim. And the best way to follow you, they can keep in touch with what your thoughts are at Tim.
They can get it all by the website.
Right.
Just mooch around on the website. Okay,
Tim. Well, I want to wish you happy holidays, Merry Christmas, and great, prosperous 2018 in this freakish market environment.
And to you, Dale. All the best.
All right. Thank you, Tim. So that's a wrap. Everyone thank Tim. Check him out. To me, it looks like Tim really has a handle on what's happening out there in the globe. I want to thank everyone for their attention today. We'll see you tomorrow for the NFP. We'll see if the U.S. government can get their act together and not have a debt ceiling problem. And also, I have a great guest, Akil Stokes. My friend will be with us for our interview. Good hunting the rest of the day, everyone. Remember, the markets will be here after the NFP tomorrow. Make sure your equity is. And above all, don't just count your pips, count your blessings. Thank you, investing.com, for broadcasting us live. Adios, my trading warrior brothers and sisters. Thank you, Tim.
Pleasure. Thanks very much.